factors influencing China's economy and what to expect for the remainder of 2024. So as the world's second largest economy, China continues to be a critical player. And today we aim to shed some light on its future trajectory, the market expectations, and also upcoming developments, especially with the significant political events in view. Our distinguished speaker today is none other than Mr. Tan Tun, Chief Investment Officer for Asia Pacific Equities at RHB Asset Management Singapore. So with his extensive experience in managing regional equity portfolios, Mr. Tan will provide key insights into the forces shaping China's market in this coming Q4 2024. So joining our panel of moderators who will help to facilitate this discussion Muhammad Wafi from RHB Sekuritas Indonesia and also Tanya Lak from RHB Securities Thailand. Thank you for joining us as moderator today. But before we move into the presentation, please allow me to share a few special promotions exclusively for you today. So first on the card is our RHB main and exclusive 2024 campaign where you can trade to earn entries for a chance to drive away with one of the three Atiwas, SUVs, and also amazing vouchers worth more than 200,000 to be won. So this campaign period will run until December 2024. Next exciting campaign available is our RHB share margin financing campaign. So by opening a new share margin account, you will enjoy low interest rate of 5.3%, facility fee waiver, and 5 times smart points on every 1 ringgit brokerage for foreign trades. So this campaign will run until 30th of June 2025. Okay, lastly, our exclusive Morning Kappa at 8 Facebook group is now open for the general public for daily stock market updates, economic news, company results, and more. So you can actually scan the QR code on the screen to have your access now. So before we move to the main event, we also would like to hear from our regional counterparts from Indonesia and also Thailand on their special promotions for you. Over to you, Wafi.
Okay, thank you, Alan. Please allow me to deliver the promotional in Bahasa. Selamat siang, Bapak Ibu, smart people. Ada beberapa poin dari promotion dari RHB Sekuritas Indonesia. Yang pertama adalah smart fee. Dapatkan smart fee dengan tingkat fee transaksi yang lebih kecil seiring dengan semakin besar nilai transaksi dengan biaya jual beli saham yang sangat rendah. Serendah-rendahnya adalah 0,08%. Kemudian yang kedua adalah smart rate, di mana Bapak Ibu bisa memaksimalkan potensi transaksi dengan margin hingga 0,025% per hari. Next, we have another promotion, yaitu adalah smart point, di mana Bapak Ibu bisa mendapatkan poin reward dari setiap nilai transaksi yang dilakukan, di mana poin reward tersebut bisa ditukarkan dengan saldo e-wallet. Kemudian yang ketiga adalah smart analyzer. Please go back to the previous slide. Ya, untuk smart analyzer, Bapak Ibu bisa menganalisa saham dengan lebih mudah dengan menggunakan fitur arrow untuk mendukung keputusan investasi. Dan yang kelima adalah smart order, di mana Bapak Ibu secara otomatis bisa memasang order jual atau beli di harga tertentu dengan syarat dan ketentuan tertentu untuk semakin mengoptimalisasi potensi keuntungan serta mengurangi potensi kerugian ketika Bapak Ibu melakukan investasi aset tertentu. Oke, next slide. We have Dapatkan, Bapak Ibu juga bisa mengunduh atau mendownload aplikasi RHB Trade Smart Syariah, di mana RHB Trade Smart Syariah merupakan aplikasi transaksi saham dengan basis syariah dan sudah seamless digital opening account, real time, quick, easy, and smart. Next. Selain itu, kami juga saat ini memiliki partnership dengan Panin, di mana Bapak Ibu yang baru saja membuka akun di RHB dengan menggunakan RDN Panin, Bapak Ibu berkesempatan untuk mendapatkan saldo reward cashback sebesar 50.000 hingga maksimal 200.000 rupiah. Next. Ya. Oke, next. Ya. Oke, jangan lupa untuk follow akun sosial media kita di TikTok, Instagram, Facebook, dan YouTube channel, serta di X di RHB Sekuritas, RHB Sekuritas Indonesia. Thank you, that's all the promotions from Indonesia. I'll pass it on to Tanya.
Thank you วาฟีสวัสดีค่ะเอ่อนักลงทุนทุกท่านนะคะสำหรับโปรโมชั่นของ RHB ประเทศไทยนะคะตอนนี้ค่ะทางเรานะคะยังคงมีโปรโมชั่นเปิดบัญชีนะคะรับทันทีค่ะวงเงินสูงสุด12เท่าของเงินเดือนนะคะสำหรับ100ท่านแรกค่ะจะได้รับบัตรกำนันมูลค่า100บาทนะคะแล้วก็ถ้าท่านใดนะคะมีค่าคอมมิชชั่นสะสมนะคะ15,000 บาทนะคะจนตั้งแต่วันที่เปิดบัญชีจนถึงวันที่31ตุลาคมนะคะรับทันทีเลยค่ะบัตรกำนันนะคะอาหารฟูจินะคะ300บาทค่ะ next ค่ะสำหรับท่านที่มีบัญชีอยู่แล้วนะคะสามารถเปิดบัญชีค่ะบัญชีอนุพันธ์หรือว่า TFEC นะคะรับเลยค่ะTesco Lotus นะคะ Gift Card ค่ะ100บาทนะคะสำหรับท่านที่มีบัญชีหุ้นอยู่แล้วนะคะ next please แล้วก็ตอนนี้นะคะทางบริษัทหลักทรัพย์ RHB ของเรานะคะสามารถทำโรบอทเทรดได้แล้วนะคะโดยการเปิดบัญชีนะคะบัญชี TFEC ค่ะแอพพลายกับโปรโมชั่นเมื่อสักครู่นี้เลยนะคะเปิดบัญชี TFEC สามารถทำโรบอทเทรดกับ Set Trade Open API ค่ะสงสัยนะคะสามารถสอบถามกับผู้แนะนำการลงทุนหรือว่าติดต่อมาทางบริษัทหลักทรัพย์ของเราได้เลยนะคะ next please แล้วก็สำหรับบัญชีบล็อกเทรดนะคะตอนนี้นะคะมีธุรกรรมรับดอกเบี้ยสุดพิเศษเลยค่ะตั้งแต่ออเดอร์แรกเลยนะคะสนใจติดต่อนะคะผู้แนะนำการลงทุนของท่านนะคะหรือว่าฝ่ายค้าตราสารอนุพันธ์นะคะรับทันทีดอกเบี้ยสุดพิเศษออเดอร์แรกเลยค่ะตั้งแต่ออเดอร์แรกนะคะแล้วก็สุดท้ายค่ะ next please สุดท้ายนะคะยังคงอยู่กับโปรโมชั่นลดท้าฝนนะคะสำหรับลูกค้าที่เปิดบัญชีในตั้งแต่วันที่15มิถุนาเป็นต้นไปจนถึงวันที่30กันยายนนี้นะคะรับทันทีค่ะค่าคอมมิชชั่นนะคะหุ้นนะคะสุดพิเศษเลยนะคะเรทพิเศษกันเลยนะคะแล้วก็บัญชี TFEC ค่ะสำหรับ3 Product นะคะที่นิยมเทรดกันก็คือ Set 50 Go Future แล้วก็ Go Online ค่ะอันนี้สุดพิเศษเลยนะคะสำหรับนักลูกค้าที่เปิดบัญชีใหม่นะคะช้าหมดเดี๋ยวอดนะคะ Thank you. This is promotion from Thailand.
Thank you, Tanya Lang, and also thank you, Wafi. Okay, so without further ado, I'm pleased to hand over the session to our main speaker, Mr. Tan Jitun. Jitun, the floor is yours.
Thank you very much, Alan. Let me share my screen. Okay, so hope everybody can see this.
Okay.
Okay, before I start, I just want to thank everybody who's attending this call today. I'm very honored and very happy to be here to share some of my views and some of my thoughts on the China market. I think today's session is very timely because obviously last night we had the big move that everybody was waiting for. So it's a 50 bips rate cut by the US Fed after such a long time, right? I think that's a rate cut that everybody was eagerly waiting for. Okay, so and in terms of great timing, so let's talk a bit about the global market in general, so that at least we can set the stage for the economic environment that China will be operating in over the course of the next few quarters. Okay, so on this chart here, you can see quite clearly, I think that's the main reason why the US Fed is so confident of cutting interest rates. So you can see US, both headline CPI and the US core CPI have been on the downtrend and steadily on the downtrend. That is obviously giving Jerome Powell the confidence to cut 50 bips, right? At his very first rate cut. And honestly speaking, I think there were people who were expecting only a 25 bips rate cut, because for them to come into the first rate cut with a 50 bips, that's actually is quite aggressive, right? And that calls into question into whether he's actually late or they should have even started cutting in July, right? So these are some of the questions that is coming up post the 50 bips rate cut. But nevertheless, I think the market in general is quite happy with the 50 bips rate cut. However, the market will be looking at a few things, which obviously for ASEAN and Asia, we have to keep an eye on as well. One is whether the labor market in the US is tiring. We can see non-farm payroll being in a downtrend, a slight downtrend, but nevertheless, in general, it's still quite strong. However, what is important to note is that there have been negative revision to the non-farm payroll numbers, right? So that is something that the market is also quite concerned about as well. And on this chart here, just want to highlight that the US unemployment rate is creeping up. So some investors are also watching this to see whether the US economy will be in a downtrend. And maybe is that the reason why Jerome Powell started cutting with a 50 bips rate cut after all this time, right? So you can see on this chart here, US unemployment rate is coming up, is actually slowly rising. And also, just very quickly, just want to touch on this slide here. In essence, I just want to share with you, the market is expecting 4 to 5 rate cuts in 2024. So we saw 2 last night already, and then maybe we are looking at another 2 or 3 over the course of the next 3 months or so. And the market is also expecting another 4 to 5 rate cuts for next year, 2025. So in general, that is what the market is pricing in. Okay, and most likely with such an aggressive rate cut expectation, meaning 4 rate cuts in total for 2024 and another 4 to 5 rate cuts in total in 2025, then our view remains consistent that I think the US dollar has seen its best days, which was in 2022, and I think will be in a weakening stance over the course of the next few quarters, because we are looking at such aggressive rate cuts that is going to happen over the course of the next few months or so. And obviously, this will have an implication on all of us here in ASEAN, no matter where you are, be it in Singapore, Indonesia, Thailand, Malaysia. I think it affects all of us. If US dollar starts to weaken, then I think that's a good thing for our parts of the world, right? In Asia in general, right? On this chart here, I think I've shown this chart previously in my last presentation to everybody. So I just wanted to reiterate this chart. So this shows the historical relationship between the US dollar and Asia market in general. Okay. So the US dollar index is the one in blue. So every time the US dollar goes down, you can see the white lines goes up. And the white line is the Asia market in general. So every time the US dollar goes down, white line goes up. Every time the US dollar goes down, white line goes up. So this trend has been very consistent. So for us investing in Asia, I think the US dollar being weak is a good backdrop for the Asian stock market to perform, right? And that obviously includes all Asian stock market, inclusive of ASEAN and also for China, especially if we look at how ASEAN and China markets have been languishing over the course of the aggressive interest rate hike cycle that we saw since 2022, right? So I think it's a welcome relief for the markets here in Asia. And now I would like to dive right into the China markets in general. So how I would structure this afternoon's presentation is simply I will talk a bit about the good, the bad, and the ugly, right? So what I am actually seeing in terms of data that is being produced by the Chinese economy over the course of this year. I think this will give us a very good understanding or background of, in the essence, what is the economy doing now. So I'm sure if you look at the stock market, you will notice that actually the Chinese stock market continues to be relatively weak. It has a very nice run from the lows that we saw during the Chinese New Year period of this year. Since then, it has a nice run up, but over the course of the last few months, in particular from July onwards, we have seen a bit of profit taking in China. So right now, I think China is still relatively flat for year-to-date performance. So let me share with you what we are seeing on the ground in terms of real fundamental data. So let's look at the good first. Okay, so if you look at the good, on this chart here, I'm showing the historical trends of China retail sales and China industrial output. So if you are living in China right now, you are spending and you're working in China, this is probably what you are experiencing. Okay, retail sales continues to be fairly decent, a bit weaker over the course of the last few months because of what's happening in the Chinese property market. But in general, we are still seeing fairly decent retail sale growth on a year-on-year basis. So you're probably averaging 3 to 4% over the course of this year. I think that's not too bad in overall scheme of things. If you are in terms of if you are working in a factory, you're looking at the industrial output for the Chinese economy, I think it's still doing quite nicely as well. So it's roughly on average over the last few months, 6 to 7% year-on-year increase. So in general, I just want to highlight to you in terms of retail sale, which is consumption, industrial output, which is in terms of production, I think China as of now, year to date, is still growing nicely. Okay, that's one good point that I can see. The other one I want to highlight to you is in terms of export growth in China. So I'm sure all of us here are well aware of the US-China tension. So on this chart here, I just want to highlight to you, over the course of this year, you can see export growth in China is in fact increasing, right? 2022 and second half, maybe even 2023, I think that the export growth have been quite weak. But this year in particular, we have seen a rebound in terms of export growth. So we are seeing positive rebound or positive growth in terms of exports coming out from China. I think in part, you can use this chart to explain why industrial production in China continues to be quite decent. Okay, this may seem a bit odd considering the fact that I think the Chinese market is still weak. So that's why I wanted to present some fundamental data to everybody to help you understand what is really happening on the ground in China. So on this chart here, I just want to share with you the GDP growth of China. So the targeted growth for this year for China is 5%. And over the course of the last 2 quarters, we have data until end June, it's still fairly decent. So it's roughly about the 5% figure. So in terms of actual export GDP growth that is being reported by China, I think it's still hovering nicely at around the 5% region. However, I just want to highlight that people are also starting to speculate whether for the next few quarters, for the third quarter and the fourth quarter, where would GDP growth be, right? So this is the question that is topmost on everybody's mind, right? But end of the day, I just want to highlight to everybody that typically when the Chinese government gives out a GDP growth number, most of the time they will either hit it or in fact, in a lot of cases, they actually exceed their growth target. So bearing in mind that, I just want to highlight to everybody that 5% is the GDP growth target for China. I think that's very, very decent. If you look at the GDP growth of all the different countries in the world, I think there's only one major economy in the world, and that's India, which is having a higher GDP growth than China, right? So only India, amongst all the major economies in the world, has a higher GDP growth than China. Everybody else, right, in all the major economies all over the world has lower GDP growth than the 5% that China is targeting for. Okay, and the other part I want to highlight to everybody is in terms of the consumer price index and also the producer price index. When people look at the Chinese producer price index, some people may look at this negative in terms of producer price index and worry about deflation in China. In essence, right, they are worried that there might be too much capacity in China. Right. So if you are a manufacturer in China or you have a factory in China, this is something that you are going to be very worried about, because producer price index is in essence the prices that you see for your raw materials that is coming into your factories. If raw material prices are on a downtrend, which probably means that probably all the factories are not doing well, That's why raw materials for the factory owners may be on a downtrend. But I will also want to highlight to everybody that yes, it is on a downtrend over the course of the last 2 years, but you can see that this trend is in fact improving, right? It is declining, but the declining on a year-on-year basis is becoming less and less, right? So in terms of consumer price index, I don't think China has an inflation problem, right? So inflation is still well under control, right? So we are not seeing deflation yet on the Chinese consumer side. But so the good that I want to highlight to everybody is that I think deflation in China is risk in China is overblown. I think in terms of producer price index, it is recovering over the course of the last few months. Next, the other good data point that I can highlight to everybody is in terms of the PMI. So I'm sure everybody is well aware of the purchasing managers index. So in terms of the purchasing manager index or PMI, we look at two different indices. One is manufacturing, and the other one is non-manufacturing or service index. You can see from the PMI data in China, I think it's still weak, albeit it's still weak, but it's still relatively on a positive trend, right? So that's above 50. So how do we know that it's on a positive trend and it's expanding? It's this red line here. This red line is 50. So anything that's above 50, if PMI is above 50, it shows that probably the economy is on an expansionary trend. So if the PMI is below 50, then chances are the economy might start to contract. But all in all, we are starting to see for most of these indicators, it's above 50. And the only indicator that is below 50 is obviously manufacturing, like what I mentioned earlier, right? So we are seeing deflationary pressures within the Chinese manufacturing sector. Okay, but nevertheless, like what I said, we are starting to see some form of recovery. Okay, the other good data point that I can share with everybody is this. For those of you who looks at earnings per share, so on this chart here, I just want to highlight to you the earnings per share trend or the EPS trends of all the listed Chinese companies that they are in the Chinese MSCI index. You can see quite clearly that from May of this year, you can see that the listed company, the EPS or the earnings per share is in fact recovering very, very strongly over the course of the last few months. Right. So from my perspective, I think that all the policies that the Chinese government have enacted over the course of 2023 and the earlier part of 2024 is starting to have an impact. So for the listed guys, right, we are seeing a significant improvement in terms of EPS. And for those of you who have been investing in the market knows, as if EPS is increasing, even if the share price remains stable, it means that PE ratio becomes lower. So it's indeed cheaper, right? So this is some trends that I can highlight to everybody. So the other point I want to highlight to everybody is that right now, just last night, we saw interest rate cuts in the US. I think the Indonesia central bank actually has preempted that and in fact have cut rates earlier. But if you look at the Chinese central bank, they have already been cutting interest rates since the start of the year, right, on this chart here. So I'm sure all of us are well aware of this. If interest rates are being cut, which means that it's probably the monetary policy is looser, and it will definitely help to buffer the economy, right? The cost of borrowing for everybody, be it consumer, be it businesses, will become lower. So I think lower interest rates and looser monetary policies will certainly help the economy. But having said that, we also understand that it takes time, right? Because using interest rate, using monetary policy is a very, very blunt tool to actually help the end consumer or the end users of credit, the companies. It will take some time for the impact to be transmitted. But nevertheless, we understand that this is obviously a step in the right direction. We are starting to see, we have seen interest rate cuts in the Chinese market. We saw that last night in the US. I think the trend is here to stay. So hopefully over the course of the next few quarters, we are starting to see this trend happening more and more, and that will obviously help to support and help the economy. Next, let's pivot to what is bad? What kind of bad indicator do I see in the Chinese market at this point in time? So on this chart here, to me, one of the key indicator that is concerning for me is the weak consumer sentiments. You can see quite clearly there was a very sharp drop off in consumer sentiment in the month of May, June, and July, right? And obviously, we need to monitor this because consumer sentiments is an indicator of how much is their propensity to spend within the economy, but it's also an indicator of how much they are willing to invest, right, into the stock market in general. So if sentiments continues to quite weak, chances are they may not spend on big ticket item or the really discretionary item, and they may not have the propensity or the willingness to invest directly into their own stock market, right? So that's why if you look at what I think are some of the more concerning indicator, I think consumer sentiments being weak is obviously not great. Okay, and the main reason why Chinese consumer indicators or sentiments are weak can be attributed to the weak property prices that we see in China. So on this slide here, what I've shared with everybody is the residential pricing in different tier cities in China, first, second, and third. So first is the white line, second is the dotted line, and the green one is the third tier city. So you can see quite clearly that over the course of the last few months, we have seen a steady decline in the prices of residential building in China. I'm sure all of us are well aware that probably or most likely a big part of our net worth is actually tagged to our property, right? The house or the home that you're living in. But if prices of these homes started to slip or go down, then obviously you might not feel as rich. And your propensity to spend, your propensity to invest may not be there. And I think that is one of the main reasons why the Chinese consumer continues to be weak, and that's mainly due to the residential prices. And as a result of that, we are starting to see, obviously, share prices becoming a lot softer over the course of the last few months, and also in terms of consumption. The really discretionary items in China, I think people are trying to postpone their buying, right? For example, in the case of Chinese, it will mainly be their house, their property, or their homes, or even a car, right? We are starting to see that. I think the Chinese government is also well aware of that, and they have enacted policy in order to try to buffer the entire economy. And on this slide here, I just want to share with you. So on this slide here, we share all the different property easing measures that has been implemented in China over the course of the last 10 months or so. I think for on this chart here, I just want to share that that for example in Shenzhen, the property losing measure was actually enacted in November. In Suzhou, Shanghai, and Guangzhou, it was done in the start of this year in January. Hangzhou was done in March. Chengdu in April. Beijing in May. So you can see that over the course of the last few months, we have seen more and more cities, and these are, by the way, are all first-tier cities. Major cities in China are starting to ease their property measures. And that's important because just to share with everybody, right, Chinese government have been trying to control property prices since 2016 to 2016. So from 2016 all the way until 2022, we have seen a whole slew of measures, right, that have been implemented in order to control the property prices in China. And to be fair, they have been successful. And some people might even argue too successful, because we have seen property prices being in a steady decline over the course of the last 18 months or so. And on top of that, we are starting to see Chinese property companies or developers going bankrupt. That obviously will also hurt the sentiments of house buyers in China. So all in all, I think we have seen the end of these restrictive Chinese property policies. And over the course of the last few months, like what I mentioned here earlier, we are starting to see property measures being eased considerably, not just in the tier cities, but also in the major cities in tier 1 and tier 2 provinces of China. Okay, so that's one. And also, just want to highlight, I think the Chinese government is also putting their money where their mouth is. Why I'm saying that is that Beijing have recently launched roughly a fund of roughly about 40 billion US dollars to buy unsold homes and idle land, right? So which means homes that cannot be sold and land that have not been developed directly from the Chinese property developer. So the Chinese government is buying homes, unsold property, and unsold land directly from the Chinese property developer in order to take out the inventory from the system. So what is important here is we haven't seen Chinese government done any of this at all. So to me, these are very, 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 very aggressive and very, very innovative ideas that they're implementing in order to clear inventory in a very short period of time. So literally, the Chinese government is putting money where their mouth is. So they have ended the restrictive property measures in China. They went on to ease the property measures in China. Now they're directly intervening into the property market. So I think it's quite significant. And if you look at the dates of when all this happened, it's actually just very, very recent, just as recent as May of this year. And this is once again, right, they are talking about it. And obviously, once they start to talk about it, it will take some time for them to implement this policy because end of the day, Chinese is obviously a huge country. It will take time for them to implement from policies all the way down to real life implementation and the dishing out of these funds to actually buy these different properties, and which include land and obviously homes. Okay. Next, let's talk about the ugly, right? So I'm sure all of us are well aware. I think the US election is just around the corner, 5th of November of this year. So who will win the White House? So on this chart, on this slide here, just wanted to highlight to everybody, I think this is a very, very powerful picture, right? I think this is the bullet that literally changed the course of the US election, right? You can see very iconic picture here, Trump, blood on his face, pumping his fist, the American flag in the background, and the sky is so blue, right? Iconic picture, right? But we also know that things are also changing very fast in the US election. I think it will be a tight race right to the very end. You can see here, red is actually Trump, blue is actually Kamala Harris. You can see over the course of last few days, we are talking about days here, last few days, Kamala Harris is in fact the forerunner now to win the presidential election in the US. But having said that, I just want to highlight, right, over the course of the last few months, they've been running neck to neck. They've been literally running neck to neck. So I think a lot of things can still change. So that's why I think it's going to be a tight race right to the very end. Okay? And I think it's going to be ugly. The reason is because I think both Kamala Harris and Trump will be using China as the boogeyman. So this is something that they can agree upon, right? Trying to control China, trying to slow China down. I think China bashing will be the way for them to win votes, right? So for both parties, I think they will try their best to enact policies that will try to slow China down. So this is the ugly noises that we will hear all the way from now, all the way until the end of the year. So for us as portfolio managers, obviously we have to react because we know that there will be a lot of negative sound bites that will be coming through because of this US election. Okay, but obviously, all of us are hoping that both US and China can coexist together. But I think it's all wishful thinking lah, because I think it's tough for them to accept that the other guy will be the number one superpower on Earth. So that's why they are trying tooth and nail in order to compete with one another. Okay. However, I just want to highlight to everybody, I think this US-China tension is not new. It has been happening over the last two presidencies. We have seen it started with Trump, right? And followed by now Biden, right? And it has been over the last 6 to 8 years. The tension has been there. 6 years ago, that's when we were talking about the tariff and we're talking about the impact on the tariff on the Chinese economy, right? So all this tariff, just to highlight to everybody, is still in place all the way until now, right? Everything that has happened over the last few years is still in place in China. And why I want to raise that is this. On this slide here, just want to highlight that this was Biden's last tariff hike on China imports that was enacted on 15th of May, just a few months back, right? So that was his final try in order to put on another set of tariffs on China. But I want you to look at the quantum. Right now, despite that Biden is trying his best to put on tariff in China, the amount affected is only roughly about 18 billion. And in our opinion, I think a lot of these tariff measures at this point in time or the incremental measures is merely symbolic and not significant. Because for this extra 18 billion, right, in actual fact, it only affected 0.5% of total global China exports, right? So obviously, Biden is trying to show his constituents, his voter base, that he is tough against China. But the toughest measures that he can enact only impact 0.5% of total global China exports. So the point I want to highlight to everybody is this: they will definitely push through measures. But as time goes by, right, the impact of these measures will become lesser and lesser because there's only so much you can do, right? So at the end of the day, I just want to highlight that you will hear noise, but I think for a lot of these policies, a lot of these measures, a lot of it will be symbolic, and the impact will not be as great as what it was 6 years ago when Trump first enacted the tariffs. Okay? Next, I just want to talk a bit about some of our, I think, our key investment themes that we are trying to have in our portfolio. So the key themes in China that we like, for example, roughly speaking, I just talk about, for the in interest of time, only 5 key themes today. One, we like the internet games. I think this is one of the fastest internet business sectors in the entire world, the Chinese internet gaming sector. For those of you who still think that there are crackdowns on the Chinese internet companies, I think nothing is further from the truth. All these strict crackdown that you have heard have all ended. So in fact, sales in 2023, 2024 is in fact higher, right, than the year before. Okay, and also why we like this sector is also that China is obviously has the highest or the largest number of gamers in the entire world, roughly about 650 million. So, and that's huge, right? So it's a very big market for them to tackle. Okay, the other sectors that we like is electric vehicle. I think the Chinese electric vehicle market is the world's largest EV market, right? And it accounts roughly about 60% of total global EV sales. And more importantly, right, the Chinese electric vehicle supply chain is very strong, very self-sufficient, and in fact, they're global leading. So they do not really depend on the rest of the world in order to produce their electric vehicle. So I think from that perspective, it's well protected from all the tariff measures, as well as all the restrictive policies that the Western world can possibly implement on China. So the electric vehicle market is actually quite well protected. So that's one of the reasons why we like it. The other sector that we like is also travel, right? The reason is travel in 2024 has roughly increased about 400%. We expect the outbound passengers from China to reach pre-COVID level soon. And also more importantly, the Chinese tourists have money. They have the highest per capita consumption for outbound tourism, right, versus anybody else in the world. So Chinese tourists is in fact very valuable to a lot of people, right? The other theme that we like is the self-sufficiency theme. I think the US-China tension is here to stay. So we at RHB Asset Management have embraced that as a fact. So we are trying to find stocks and sectors that will benefit because of this US-China tension. And one of the key themes that we are playing is obviously self-sufficiency. I think the sectors that are very, very key to the Chinese economy, like for example, tech, autos, high-end computing, these sectors will be very well supported by the Chinese government policies. And for us as investors, if we were to invest into these sectors, I think there will be massive support from the government in order to stimulate the entire sector. Okay, I think it's inevitable that the Chinese government will try to reduce China's reliance on foreign imports, right? And I think we are starting to see fruits of that happening over the course of the last few years. Last but not least, because of the impending interest rate cuts that we are going to see, our view is we like the high dividend yield names, right? In an interest rate environment that's falling, bond yield will obviously be falling in tandem as well, and that's when high dividend yield stocks starts to become more attractive, right? And more importantly, we are starting to see more and more interest rate cuts happening, right? So the interest rate cuts, once it's usually a trend. So once they hike interest rate, it will go up. You'll keep hiking. Once you cut interest rate, chances are they will keep cutting. right? So, and I do think that right now, I think the economic environment, the equity environment is still very volatile. So having a portfolio or a few names of high dividend yield stocks does provide stability to overall portfolio. Okay, and specifically, I just want to highlight some of the names that we like. For example, I think Chinese internet names, like for example Tencent, is actually quite interesting. So global leader, and obviously it comes up with a whole host of games that we think are attractive. So this is just one of the examples that we like. For example, BYD is an interest is it's a name that we also have interest in. I think BYD is one of the largest EV producers in the world. So and they have a big and a rich portfolio of electric vehicles with an exciting lineup as well. So these are some of the names that we think are interesting that we have on our radar list. So I'm conscious of time, and maybe now I'll hand over the floor back to Alan for any Q&A from our audience. Thank you very much, everybody.
Okay, thank you, Jitun, for the interesting outlook on China. To all the participants, you can key in your questions into the Q&A. So while we are waiting, let's maybe start with the first question from my end here.
Sure.
Okay, so basically this one after FOMC has cut 50 basis point, what is your view on China's interest rate themselves?
Okay.
How soon you want to see any action from the government?
Okay. So like maybe I share my slide again. So in terms of the actions from the Chinese government, I would say that they have been cutting interest rate already, right? Even preempting the US market. So in terms of, let me share with you this slide here. So this slide is a historical trend of benchmark interest rates. As you can see, I'm highlighted in this pink circle here, right? So they actually started to cut in the June-July period already, right? So like I mentioned earlier, I think chances are they will start to cut more, right? But the problem right now in China is not so much that the interest rates in China are high, right? The issue in China is that whether they can stimulate demand enough so that people will borrow from the banks in order to buy a new car, a new home, or to maybe start a new factory, or to embark on a new capex cycle, right? So in China, it's more of a demand story. But in terms of interest rates, I do think that the Chinese government can and should continue to cut interest rate. The other thing I want to highlight to everybody is also that one of the other impact from the interest rate cuts from the FOMC is on the impact of currency, right? Previously, when the FOMC hiked the interest rates until it's at 5+%, then if you're an investor, you may think that, I can just easily buy US treasuries. I don't have to take any real risk. US dollar is a strong currency, right? Without taking on too much risk, I can still earn a fairly decent 5+%, and maybe that's good enough. But right now, if we are in an interest rate cut cycle, then that kind of thinking doesn't really work already, right? And then people may start to investing outside of US dollar assets. So I think that's one thing that will have an impact on the rest of us, right? In particular for China, because previously at some point in time, I think some investors were actually worried that because Chinese interest rates were getting cut, but US interest rates still were relatively high, would there be capital outflow? What would people think about that? What about think of renminbi? But we haven't seen that much of a capital outflow, like, honestly speaking. And now that trend has reversed in terms of US interest rates, I think that obviously will become less of an issue in terms of capital outflows from China to the US, right? So that would be my answer. Alan, over to you.
Okay, thanks, Jitun. Okay, let's move on to the next question. Recently, Alibaba is proposing to return to Hong Kong as a primary listing. Thereafter, the share price have been moving upwards, right? So, do you see investors welcoming this decision? That's the first part. The second part of the question is that how will this impact on overall Hong Kong stocks?
Okay, I think it's a very good questions. The fact that Alibaba being able to have a secondary listing in Hong Kong, I think it sent a very, very strong signal, right, to investors in general, that Hong Kong is once again open for business. So people, investors, over the course of the last few years may have the wrong perception that Hong Kong is hollowing out. Things are really bad in Hong Kong. That's why the stock market in Hong Kong is also may not be in such a good shape. But now that with Alibaba having a secondary listing in Hong Kong, that will also signal that once again, Hong Kong is open for business. And also the impact on Alibaba is also good, because not only that, I think Chinese investors who are onshore in China, who used to be able to only invest in onshore stocks, A shares, are now able to buy Alibaba as well. So that in essence, right, opens up a huge pool of potential investors for Alibaba. And bearing in mind, right, who are the ones who make Alibaba the behemoth that it is right now? It's obviously the Chinese themselves, because they are obviously very supportive of Alibaba and all the different services that Alibaba provided. Previously, if Alibaba is only invested in US, they can't have US dollars to buy all these stocks. But if they start to move their listing to Hong Kong, and if Chinese investors themselves are able to buy Alibaba stocks through the Hong Kong Stock Exchange, through the Stock Connect, then once again, they will provide obviously an extra pool of investors that were never available in general to Alibaba, right? By opening up all these onshore China-based investors. So that's why Alibaba stocks have been doing quite well. And in general, that will obviously, have some knock-on impact to all the internet stocks that are in Hong Kong as well, right? So in general, I look upon that very favorably, right? Having a secondary listing, and obviously that will have a positive impact on the share prices of tech stocks in general.
Okay. So in the perspective of dual listing from normal investors' point of view, what would you think? Is it better to go to the US one or the Hong Kong one?
Okay, so in general, just to share with you, so for us at RHB Management, for our fund, right? Let's say, for example, the RHB Big Cap China Fund, we actually have both. I actually have both share class. The reason why I have both is not because one is cheaper than the other. It's because it allows me to trade technically Alibaba 24/7, 24 hours, right? Not 7, 24/5 lah, right? Because on some days the US is on holiday. During the Dragon Boat Festival, Hong Kong is on holiday. So, but if I have both stocks, right, I'm able to buy and sell and make changes to the portfolio effectively. So in essence, I'm able to trade 24 hours, both on during the Asian hours as well as during the American hours. So this is one of the main reasons why I, as a fund manager, do it for my portfolio. But in general, over time, right, because these two stocks in essence are the same stocks. So over time, right, in terms of valuation, if you take into account fees, if you take into account exchange rates, technically they will trade very, very close to one another, right? So for me, from my perspective, for investors, if you have US dollar and you don't mind waking up to trade the US BABA, feel free to trade the US version. But if you are trading in the US, in the Asian time zone, you want to implement your stocks ideas during the Asian period, that you can trade the Hong Kong version.
Okay. Yeah, thanks. Okay, let's move to Indonesia. Wafi side, you got any question for Jitun?
Yes, thank you, Alan. Thank you, Jitan, for the presentation. I have several questions came in directly to me. The first one is quite in line with the two questions came in the chat box regarding the tariff from the US. But I like to elaborate a little bit more because currently the tariff hike or anti-dumping policy is also coming from various countries, not also from the US, but from other countries, including Indonesia now. Shouldn't it be bad for the China export and resulting for another negative impact toward the China household income growth?
Sure. So, okay. So obviously there are allegations of dumping from various regions all over the world. Okay. So I think from the Chinese perspective, from the Chinese company's perspective, okay, let's put it from Chinese company perspective. So they are well aware that if they produce in China, whether they get the so-called subsidies or not, whether they get any preferential treatment or not. Because if once you produce onshore, people will say that, you know what, you have unfair advantage, you have unfair subsidies. So I will investigate you. I will try to put tariffs on you. Okay, so no matter whether you actually do it or not, that is going to be the allegation. So what a lot of Chinese companies are doing are saying that, forget that. I will build the factory in the region. I will build the factory in Asia. I will build the factory in ASEAN. I will build the factory in Europe to get around the problem, right? So I think I have to differentiate lah. So if you think about it, right, even if you are a Chinese company, you were to set up a factory in the US, even if you want to, will they allow you to? Right? That's one issue, right? So I think the China-US tension is a bit more different, right? It's not just on trade. It's not just on pure financial terms, because I think the competitive landscape for them transcends a few levels. It's politics, it's military, it's everything, right? So and tariff is just one of the many measures that the American government is trying to put on China. But I think for other parts of the world, right, whether it ASEAN or is it Europe, I think it's simpler, because obviously Europeans and ASEAN members, we are not competing against the Chinese on so many different levels. For us, it's more straightforward. It's all economy. It's all about dollars and cents. Are you really dumping, subsidized goods into our markets? If that's the case, that's not fair, right? So for them, I think for the Chinese, dealing with other parts, non-US part is simpler, right? As long as they are willing to open factories, be it in Indonesia, be it in Thailand, in Vietnam, in Malaysia, in Singapore, I think all of us will welcome the Chinese investors with open arms, right? Whether the car is branded BYD or Geely, but if they are built in our parts of the world, I think that's fair. We will welcome it with open arms. I think that's one way when I think about things, right? Because it's essentially that's what the Chinese are doing, right? Because right now, a lot of the Chinese players, at least the guys that we are investing in, are no longer just made in China brands that is only sold in China, right? The likes of, for example, BYD. It's sold all over the world, right? Obviously, it's obviously a Chinese brand, but nevertheless, it's sold all over the world, right? So I do think that that is how I would think about it, right? A lot of these Chinese companies that we talk to are already well aware of this issue, because I'm sure all of us are well aware. Tariff is a problem that we talked about 6 years ago, 8 years ago, right? And we have also seen in all our countries that for all of us who are on this call, we have seen Chinese companies investing directly into all the countries in ASEAN, building factories, working with local partners, shifting their supply chain from only China to China plus one. So all of us here are actually beneficiaries from this China plus one policy. So that's one of the ways that trying to get around it. But obviously it will take time, because it's not so easy to just shift a factory. You need to build the entire ecosystem of suppliers to help you build up the entire factory, right? So in my view, I think that we will see, obviously, tit for tat, or maybe the European guys will want to follow the Americans, right? Even we saw Canada do the same thing, but to my knowledge, I don't know of any Canadian auto brands in the world. I don't even know whether Canada has any, actually export cars outside or not. But nevertheless, they are putting in tariffs. So you have to think, is it pure economic, or is there some element of politics as well? But like I said, right, then for other parts of the world, I think things are, for lack of a better word, cleaner, right? It's pure economics. Yeah.
Okay, understood. Thank you. And second question is regarding the home ownership policy. Could the home ownership role being left up, or could it be possible to cause another bubble, which could lead to worsen China economic in the midterm? Considering also companies in China have been cutting costs, resulting to lower income growth, which shrinking the disposable income.
Okay. So I don't think that it will be another bubble. The reason behind this is because I think we are seeing a lot of excess capacity in China right now. There's excess inventory in China right now. Okay, so that's one. Second of all, which I think is a more important impact, is the psychological impact, right? So prior to this China property crisis, right, I think for the younger generations of Chinese investors of property, their concept was only that, you know, uh that property prices can only go up, right? So they buy multiple property, sometimes even on leverage, right? So so that is it's a massive, to me it's a massive mindset change over the last few years. I think a lot of people, it's a weakening call to invest property investors, that, you know, you can't expect property prices to keep going up, right? But also I just want to highlight that in a lot of cases in China, right, the first property is the normal mortgage um, system that you and I are all very familiar with: 20% down payment, 80% loan from the bank. But if you buy second or third property, in a lot of cases, for the third property, it's 70% cash, 30% loan. More than that, you can't even loan, and you can't. It's all cash, you see. So technically speaking, I think some investors will look at it and say, "Hey, you know, property price is so high, is it a bubble?" But in the actual fact, is it really a bubble? Because in a lot of cases, right, the Chinese property market is funded by real cash. People are using cash to buy the property, or the large part of their exposure to the asset is through their own cash. Very little of it is through property loans, right? You are talking about second or third property, right? So in that scenario, right, when people are worried about a property bubble, let's say for example in the US, it's very different. In US, there's a property bubble, and that's dangerous because it's all done through leverage, right? Right? It's all done to leverage, very little down. It's all through leverage to the banks. But in China, it's very different, right? So I think there may be a misunderstanding about the different property construct, right, in different countries. So from my opinion, I think this whole removing or the easing on the Chinese property bubble, I think will not cause a property bubble. It will in fact will help to clear a lot of inventory, right? But also I want to highlight, right, that during this whole crisis, a lot of property developer have gone belly up. A lot of them are bankrupt, and a lot of them, and even some of them who are in the top 10 property developers 5 years ago have now gone bankrupt. So what it has also happened is that the property developer market, or the landscape in general, has become a lot more disciplined, because a lot of the cowboy players are out. Even the big guys are all out. So there are fewer players controlling bigger market share. And those people who survive, a lot of them do have central government, provincial government as backing. So that's why they're able to survive. You know, property financing, the bank financing carries on, right? So that's why they are survived despite all these dark few months, or dark few years, right? So that means that the whole property developer market is becoming more disciplined, right? More disciplined, can be easily controlled, because if a private developer versus, let's say, a GLC, you can know that the span of control is different, right? So I do think that it makes for a safer environment in general. So that's why I still think that the property developer, for those of you who are those of them who are in trouble, will continue to be in trouble, right? Because this is, unfortunately, is the real world, that is the real truth, it's the hard truth that they are facing right now.
Okay, understood, Jason. And the last questions from my part is regarding the some article in the SCNP website show to counter the slowdown from the property sector, the Chinese government is ramping up its three sector regarding the EV, ion battery, and solar panel. It's renewable, and also an article from the SCNP said that the Chinese becoming the new Saudi Arabia of the renewable energy. But compared to the size, the renewable, I think, still small from the property sector. So, what do you think the Chinese government will navigate this renewable policy towards
Okay.
the futures of economic China?
Yes. Once again, very, very good question. Very interesting. Things that we are also thinking. Okay, so to be fair, right? Chinese property market at its highest contribute roughly about 20% directly, another 5 to 8% indirectly. All right. So the impact of the Chinese property market is huge, right? I don't think that the renewable plus EV plus whatever new technology they come up with, right, can take over the Chinese property market in a very short period of time, right? So that's not possible. That's not possible. So that's it's very important for the Chinese government to actually put a floor on the property market so that it doesn't deteriorate more. Because if it's 20% of the GDP and it start to shrink like 50%, wow, that's going to be a big problem. So that's why it's very important for them to put a floor in, right? So to me, right, I think the renewable energy, EV, I think these are structural trends that the Chinese government have identified, right? And obviously these structural trends will benefit them the most. Like for example, Chinese used to import a lot of oil, and obviously they are not an oil producing country. It doesn't make sense for them. So for them to have renewable, to be what you mentioned earlier, the Saudi of renewable energy, I think that makes a lot of sense from a long-term planning perspective, right? You can reduce reliance on outside people, do something that you are strong in, right? So that's something that I think they are on the right track there. But unlike oil, for example, for the Saudis, right? Oil, you cannot just make oil, new oil, right? But for renewable, technically speaking, prices of solar panels keep going down. Prices of wind turbine engines keep going down, right? So you can actually make new ones, right? So, but I do think that the trend is obviously the correct one. They are trying to somewhat substitute some of the demand that has been destroyed because of the property to these new sectors. But I think their thinking is perhaps even further away. That end of the day, I need to reduce reliance on external sources, be it oil, be it technology, right? I need to build my own capabilities, and these capabilities happens to be right up their alley, right? So it's a win-win for them from a lot of different perspective.
Okay, thank you, Jitan. So I guess that's a negative sentiment for the oil and the coal price as well. Okay, I think that's all from me for now. Alan, back to you.
Okay, thanks, Wafi. Moving on to Thailand, Tanyala, you got anything for Jitun?
Yes, I have a few questions because
Sure.
we have a limited of time.
Yeah.
So, too straightforward. What is your view on because of the rate cut? What is your view on the insurance and banking sector? Because these two sectors quite like huge market capital in China.
Okay. Once again, very good question. So, in general, right? In general, interest rate cuts. Okay. So let me talk about in principle, academically, right? In academically, right? If you cut interest rate, it's usually bad for banks, right? Because banks depends on net interest margins. Once you cut, then obviously net interest margin goes down. It's tougher for the banks in terms of earnings, right? This for normal banks. Banks I would say in Malaysia, Indonesia, in Thailand, Philippines, Singapore, all operate this in the same way because we are very free market. But in China, it's a bit different. The Chinese government control borrowing rates as well as lending rates. So they control both sides. If you cut interest rates, if your borrowing also goes down, your lending rate can also move up and down. So and also in China, right, the Chinese government, at least for the big banks in China, the Chinese government is the largest shareholder. So they also want the banks to survive, right? So there are a lot of mechanisms that they can play with. For example, because since they control both the lending rate and the borrowing rate, so they can make sure that the banks own a decent enough margin. Then they can play with the fact is how do they stimulate in terms of growth? Where can these banks lend to? Because they obviously lend to all the GLCs as well, so they can control who you lend to, right? Who to do business with, right? And also in terms of policies, like for example, I want to develop a certain area, I want to do a certain program, then the banks will come in, then they get a lion's share. So net, the bank is used as more like a tool, right, to facilitate the ambition of the government as well as to facilitate the programs of the government. So in general, banks in China are less affected compared to the market-driven banks that we have in Thailand, in Malaysia, Indonesia, Philippines, and here in Singapore. Is a bit different because we are more subjected to market conditions, right? Because we don't control both lending rates and interest rates, and we don't control all the customers, right? So in general, banks, I think they'll be okay. The big critical issue for banks is more a case of whether they can get enough loan growth in China. One, the other one is whether the property market will it degenerate even further, or would it be contained? So these are the main drivers rather than the interest rate factor. So same thing for the insurance company, because insurance company in China is very well regulated, right? The biggest fear for a lot of insurance company all over the world is this: if you cut interest rate, but if you the policies rate that you have promised is so high, right, you cannot match, right? That's when banks or insurance company will start to face problems, because your policy rates that you promise the policy holders is too high, and interest rate that I can get from the market is too low. So there's this big discrepancy that you have to make up for, right? But in China, it's a very regulated insurance sector, so they control it pretty tightly as well. And bear in mind that once again, a lot of these big insurance company in China are all their biggest shareholder is obviously the Chinese government, right? So that in essence, I don't really worry, right? But obviously in other parts of the world, when we see big interest rate cuts, then the policy rates are too high, then the insurance company run into trouble. But I don't foresee that once again for China, both on the banking side or on the insurance side.
Okay, last question. In case of the in the US election, in case of Trump win, will we see like the Trump effects to the because the Trump policy would like to bring back the business to US, right? Will we see like the last time that it happening in the Trump 1.0 economy?
Okay. Once again, very good question. So our view is, because we did analyze this from a lot of angles. Okay, one, I want to highlight to you. One, Trump 1.0 was big because it was the first time we have such a big policy, tariff policy that's enacted on China. So the big impact, the shock was big, right? But like I said, after 8 years, right, the shock gets minimized, right? Because if there's tariff, then companies will react. China plus one policy, you would, set up factories in other parts of the world like ASEAN, or you find a way to make sure that you may build the basic parts, but you get it assembled in some other countries, and then you get exported from some other places, right? So there are ways around this, right? So over the last 6 to 8 years, the market have also changed, right? So things have changed. So the first impact is always big. It's like us when we are young, or when we are kids, right? When they fall sick for the first time, it's always very big. First time they get a flu, wow, very serious, high fever, they're sick for 7 days. But second time, third time, when they get flu, right? Today, tonight, they're not feeling well. Tomorrow, they're up and running because the body get used to it. I think the market is also something like this, right? There's only so much Trump can do, right? Logically, right? Because end of the day, China has 1.4 billion people. It is the factory of the world. If you don't let the Chinese produce, where can you produce? If you don't let the Chinese produce iPhones in China, obviously you can do it. You can have it assembled in Texas or in New York, for that matter, for California. But what would be the cost of an iPhone? Right now, it's already $1,000 US. If you get it in California or in Texas, how much would the iPhone be, right? So there's also an extent to which Trump can push this for a lot of these consumer goods. But obviously things like high-end IT technology, that's a different story altogether. But in terms of consumer goods, right, I think whatever Trump has done, then Biden went on and did a round 2. Then the last example that I did, right, was the last tariff that he made, that he implemented on China, is already very, very small, right? So the incremental effect will get smaller and smaller and smaller and smaller, right? So I do think that there will be a lot of noise because Trump is Trump. There will be a lot of noise, but I wonder what can the impact be, because it's been 8 years, 2 presidents already, right? So yeah.
Yeah, thank you so much. Back to you, Alan.
Okay, thank you, Tanya. Okay, maybe we got time for one more question, Jitun.
Sure.
Okay, since Huawei has launched a 3-panel monitor phone, and iPhone seems not so popular in China. So what's the investment opportunity in terms of Chinese tech stocks?
Okay. Once again, very good question. So, for us as well, when we think about this, right, there are a few aspects. One is the significance of it, so the symbolic act of it. The fact is, having a Huawei 3-panel iPhone is big, right? Because it's special. It's special, and they can mass produce it in a big way, right? So that's the symbolic part of it, right? The other part of it is in actual fact, right? What is the impact on the stock names, right? Because at the end of the day, I think Apple is still Apple. The Apple ecosystem is continuing to be very strong, right? And bearing in mind that a lot of most in fact all of Chinese Apple phone that are sold to the Chinese are obviously assembled in China. We are well aware of all these guys who are playing in that space, right? So the Chinese does benefit, right? So it's not just Apple. Obviously, Apple take most of the margin, right? But the Chinese Apple supply chain in China will benefit because of the Apple one as well. So that's something that we are playing, okay? But the Chinese, for me, it's more the symbolism, right? That they are able to come up with something new, and we know it's they will just keep improving, right? The Chinese are never going to stay still. They will start improving year by year, month by month, model by model. At some point in time, they will get very, very close to the Apple phone at some point in time, right? So I think that's one aspect. And the other key aspect I want to highlight is also consumer habits, right? If you are like like us, I mean a lot of us, you're probably very used to the Apple ecosystem, or we are very used to Samsung ecosystem. We are stuck. We just don't want to change just because we are so-called lazy, right? We can't be bothered to change a new one. But if the Chinese keep coming up with newfangled stuff, and the Chinese like this new stuff, right? 3-panel phones or whatever, then they will switch. Right? Chances are once you switch, it's harder for them to switch back in, for Apple to attract them back. Because we know that Apple technology usually it's it's not a technology that will attract them. It's the ecosystem, right? So once you establish an ecosystem that is very hard for the Chinese consumers to pull themselves out of, then that's another story lah. So to me, it's also that aspects that I have to think about. Yeah, Alan.
Okay. Thank you, Jitun. I think that's all the time we have. We hope that this event has been informative for everyone. So our sincerest thanks to Mr. Tan Jitun for today's session, for sharing his expertise and also in answering all the questions that was posted. A big thank you also to all the participants. Thank you for joining us from near and far. So we hope to continue to see you every day at RHB Morning Kappa at 8 daily for all the latest information and news. So till the next session, have a good week ahead and see you again soon. Thank you.
Thank you, everyone. Thank you.
Thank
Bye.
you.